Yeah, I think more or less everyone has now come through and joined. If there are any further participants to come in, I'm sure they can catch us up. So welcome this morning, everyone, to the latest in our annual series of webinars with the Bank of England. We're delighted again to be joined by Paul Mounts, Deputy Agent from the Bank of England. He's very kindly given up his time this morning. I think if there's anything we've learnt through our experiences over recent years in business, it's that ultimately we're in a position of constant change and challenge. So hopefully Paul will be able to get into the detail of that and help us through, understand a little bit about some of the impacts that that's having right now on the economy and perhaps a little bit of guidance as to what that might mean for us over the coming sort of months and into the next year or so, and particularly the sort of Bank of England's view. As always, one of the most important aspects of this morning's session is the ability to post some questions to Paul. So I'm sure lots of you that are joining us this morning will be keen to get some specific insights from Paul. So please do use the chat function. Hopefully at the bottom of the screen, people will be able to see that. You can use that to post some questions at any point this morning. We'll try and get through as many as we possibly can. I suppose without too much further ado, I will hand over on behalf of Horsens to Paul to start taking us through this morning's session.
That's great, Pete. Thank you, and thanks everybody for joining. I'm gonna talk for probably about 20 minutes. I'll say a little bit about what the Bank of England does and the sort of framework for interest rate setting, and then I'll go on to talk about some of our forecasts and some of our sort of views of the economy. So if you could move us on a slide, please, Darren.
Yeah.
Maybe one more, Darren. Great stuff. Thank you. So someone needs to go on to mute, I think. I'll just say quickly, I think we've got a bit of background noise there, but if someone's not on mute, if you could pop yourselves on mute. So very quickly, the Bank of England's sort of role in the economy, I always remind people that the bank's sort of part of the public sector. We're government owned, but we operate independently. So we operate under a government mandate, and they set the mission, which is around maintaining monetary and financial stability. The monetary stability bit is all about inflation and using the interest rate to influence inflation. So broadly, the bank's role is to try and set the conditions, a sort of stable economy under which you as businesses and as households can sort of thrive with a degree of certainty and helping to sort of make decisions for the future. If you move us on a slide,
For some cash.
Right, so there we go. I think you're all back on mute. Okay. So look, let me say a bit about how the bank uses interest rates to influence inflation. So the government sets us a target for inflation, and that's the measure of inflation is based on something called the Consumer Price Index, which is a basket of goods that the typical household consumes, and that's collected by the Office of National Statistics, and that's a 12-month measure of inflation. So it shows how much higher in the last 12 months, it generally is higher, not lower, how much higher sort of general prices in the economy faced by a typical household are relative to a year ago. And the government sets us that target at 2%. I've already said sort of low and stable inflation is seen as a foundation of a strong economy, helps households and businesses make decisions with a degree of certainty. The only lever of economic policy that the bank has to influence inflation is bank rate or base rate, which effectively is the key the key interest rate in the economy. So when the Bank of England changes its base rate, all other interest rates on loans and savings will change very quickly. The sort of basic economic theory is that if the Bank of England raises base rates, that interest rates in the economy increase, that restrains spending, that would pull down demand in the economy. So if inflation was higher, we'd be moderating demand, and you'd expect, therefore, sort of prices to fall back a bit. Conversely, if inflation is low, the economy is weak, we can reduce base rates. That increases the level of demand and activity in the economy, and that tends to push up prices, and inflation would tend to increase. We try and bring inflation to target sustainably. So there are various shocks that will hit the economy. We can't always use interest rates to influence those. So we will tend to try and look through things like an oil price shock, for example, and focus on the sort of underlying cost and price pressures in the economy. Something I will always stress is that there's a time lag between changing the interest rate and that feeding through into changes in demand in the economy, and therefore in inflation. So in a sense, the people at the bank who set interest rates are always trying to second guess what the economy will look like in sort of 12 to 24 months' time to understand what the appropriate interest rate is today to be influencing demand over the next sort of one to 2 years. And I'll come back to that later on. If you could move us on a slide, please, Darren. Very quickly on the process for setting the base rate. The bank has something called the Monetary Policy Committee. It's 9 independent members sit on that committee, and it meets 8 times a year. So 8 times a year there's an interest rate decision. 4 times a year that decision is informed by a UK economic forecast. So we update that quarterly. That comes in February, May, August, November. So the forecast I'm going to be talking about today is the bank's May forecast. There'll be an updated one coming in a few weeks' time in early August. In terms of my role in the agency network, so the Bank of England has agencies across the UK. There's usually 2 agents in each region. And our job really is to be out talking to businesses about how they see the economy, how they see the sort of forward-looking picture for the economy. We theme that information across the UK, and we feed it directly in to the interest rate setters at the bank to try and give them a really sort of strong, up-to-date view of how businesses see the economy, to help them, set interest rates sort of in the interests of keeping inflation low. So if we move on one, please, Darren. So this, I won't go into too much detail on this graph, but it's showing the inflation, sort of headline inflation since 2021 up to the present, and then with a sort of short-term forecast to the end of 2025. So the white line is sort of headline consumer price index, and then the bars are showing various of the sort of key components. So the sort of gold bar at the bottom is showing services inflation. That's about half the consumer price index, and that will include big items like sort of hospitality, hotels, transport, and so on. We've broken out food there as well. So I think most of you will be very familiar with the sort of story of inflation from sort of 2021 with the COVID shock, and then the Russia-Ukraine shock and higher gas prices. We have much higher inflation in the UK than we've had for many decades. Sort of towards the end of 2022, inflation peaked at about 11%. And inflation at that point was very much driven by that gas price shock. We had very strong sort of increases in utility prices, but we also had big increases in parts of the consumption basket, which we're very dependent on energy. A good example is food. So food price inflation towards the end of 2022 was running at about 20%. And it turns out that energy, food production is very intensive in energy use. Inflation has come back down significantly since that sort of October 2022 peak. That's in part because the bank's raised interest rate, but it's mainly because it's a 12-month measure of inflation. So some of those very large increases in prices that consumers saw during 2021-22 have just simply dropped out of the index. So the prices remain higher than they were, let's say, pre-COVID or pre-Russia-Ukraine, but over a 12-month period, those increases have just dropped out of the measure. We've currently got inflation at 3.4%. That was the May 2025 figure, and we think it's going to stay around that level for the rest of the year. Now, clearly, that's above target, and I'll say a bit more later about, I suppose, how worried we are about inflation, hopefully temporarily being above target. But that's the sort of inflation outlook. If you move us on one, Darren, I'm going to say just a bit more about, in the next few slides, about the sort of current economic outlook. So this one is showing a sort of bank estimate of underlying GDP growth. So the actual GDP numbers have been very volatile and typically are very volatile. They get revised quite regularly, but we've got a sort of survey-based indicator model of what we'd call underlying GDP. That's currently showing that GDP is very weak, and I think that aligns very well with the last sort of couple of numbers from the ONS on GDP, which have shown slightly negative GDP. It fits very well, I think, with what we hear from businesses and what other surveys of businesses are telling us, that the underlying sort of economic activity in the economy is pretty weak. And I'll say a bit more about that in a minute. But if you move us on one, Darren, sort of weakness in activity is also reflected in a weakening of a loosening of the labour market. So employment growth has softened quite significantly. We've seen the number of vacancies come down. We've seen unemployment tick up a little bit, and we're also starting to see wage pressure in the economy ease off quite significantly. So there's a definite sense, I would say, when we speak to businesses, that actually after a very long period of the labour market being very tight and it being very difficult to retain and recruit people, that's broadly coming to an end, and it's becoming much easier to retain and to recruit people. There's always the odd exception, but that's the sort of general picture. If you move us on one, please, more, Darren. So what's underlying sort of weak activity, weak employment growth? We've seen a lot of weakness in surveys of business investment intentions, business confidence, and I think that very much reflects, and again, this is based on the discussions we have with business, that there's a considerable amount of uncertainty, geopolitical uncertainty with what's happening around trade and tariffs. And I'd also say, despite Labour having now been in power for a year, there's still a degree of uncertainty, I think, about having a new government bedding in, the sort of policies, still quite a lot of changes to government policy coming out, and also people wanting to wait and see in terms of sort of actual implementation of change. So a definite sense of sort of economic, geopolitical uncertainty, and that's putting a constraint on firm investment intentions. And if you move us on another one, please, Darren. What we're also seeing is that consumer confidence is very, very weak. And this chart is showing the household savings ratio over the last sort of 20 years or so. And we can see that ratio has increased quite significantly during the last couple of years. So households are saving more than we'd normally expect them to. And when we look at some of the more detailed surveys of why households are saving, the sort of idea around people just being wary about job prospects, about general uncertainty in the economy, that there's that sort of security aspect to saving more. And that's just reflected in people not being out sort of spending in the way they might have been a few years ago. So if you move us on another one, please, Darren. So that's a bit about sort of where the economy is now. So, generally quite a weak economy, inflation above target. There's a hope that that's partly driven by some temporary factors like higher sort of utility prices, but we are above target and expect to be so for a while. And unemployment also starting to to tick up, albeit from a very low level. I'm not going to say too much about the forecast here. So you can all see the table. The top three rows are those sort of key economic variables. So real GDP, consumer price inflation, and then the unemployment rate. And the forecasts are showing a sort of 3-year ahead forecast for those different economic variables. I should say the figures in brackets are what we had from the previous forecast. So this is based on a May forecast. The figures in brackets are what we had in February. These forecasts, and this is true for the bank and any other forecasting organisation, tend to move around quite a lot, and they move around quite a lot because of some of the input variables will tend to change quite regularly, things like oil prices, gas prices, particularly in times of economic uncertainty. But the general picture from the forecast we have is of growth picking up over the forecast horizon. I would say the GDP growth approaching 2% at the sort of 3-year point. There's, I think, a fairly heroic assumption in there that household investment in new housing picks up very significantly. That, I think, is probably slightly questionable. So that number, I think, looks probably a bit high, that we're getting to 2%, because I think conversations I have with firms in the sort of house building construction sector suggest that we will see more house building, but getting anywhere near the government targets is going to be really difficult. Inflation, we've got coming back to target in the sort of medium term, and then we've got the unemployment rate ticking up to about 5% from about sort of 4.5% now. So an increase in unemployment, but not sort of catastrophic levels of unemployment. If you move us on one, please, Dan, I'll just say, I'm not going to go through the detail of this one, but this slide is the sort of inputs to the forecast model. We call them the conditioning assumptions. So, for example, the top line, bank rate. So the Bank of England forecast model always uses financial market expectations for future interest rates as an input to the model. We've also got the exchange rate, oil prices, gas prices. They all tend to be based on financial markets sort of futures curves. Now, those tend to move around a lot. And as those move around, the forecast will change. And that's the reason we do a quarterly forecast, because these things can change quite regularly, and that will impact on what the forecast model is churning out. Essentially, that's true for the bank, that's true for Goldman Sachs, HSBC, Office of Budget Responsibility, all these other big sort of institutions who regularly do economic forecasts. If you move us on another one, please, Darren. I always feel like I should say something about sort of tariffs and trade fragmentation during these discussions, despite it tends to change pretty regularly. This was a table that we included in the February Monetary Policy Report. So if anyone's interested, the February Bank of England Monetary Policy Report has a sort of 3-page box explaining some of the different channels through which tariffs and trade fragmentation could impact on the UK. The sort of high-level message is that we feel that sort of tariffs, trade fragmentation will inevitably reduce UK GDP. The impact on inflation is significantly more uncertain. So there are certain channels through which tariffs can affect the economy, which will push up on inflation, but some will actually bring it down. So still very uncertain, I think, what the impact of tariffs will be on the economy, and that's partly because we haven't yet settled on what the US tariffs will be and how others will respond to those, what the various trade deals will be. So this is something that there's a sort of team at the bank is looking at sort of almost week by week. But considerable uncertainty still in the sort of trade picture. If you take us on one more, please, Darren. So look, where next for base rate? I guess that is where a lot of you will be interested. Is the last interest rate decision was in the middle of June, and the Monetary Policy Committee voted by a majority of 6-3 to maintain bank rate at 4.25%. So we've had sort of 4 cuts since the peak in 2023 at 5.25. We've come down to 4.25. They've been moving in sort of 0.25% increments. There were 3 members at the June meeting who wanted to reduce rates by 0.25 percentage points. And I can say a bit in a minute about the sort of different views on the committees. But the general message, I think, coming from the committee is we've seen substantial disinflation over the past couple of years, and that has partly been underpinned by a restrictive stance of monetary policy, is the way they talk about it. Generally, the sense is that a neutral rate for the interest rate would be about 3%. So a rate of interest at about 3% would neither be pushing up nor pulling down on demand and inflation. So we're still at a restrictive interest rate of 4.25. They talk in their sort of minutes about second round effects. That's quite important, and it's quite important particularly because inflation has sort of nudged up a bit. So those of you as old as me might remember talking in the 70s and 80s about wage price spirals. So when we're talking about second round effects, we're talking in a sense about if inflation is above target, is that almost becoming a sort of self-fulfilling prophecy? So I would say some of those on the committee who are perhaps a bit more cautious on cutting rates are probably a bit more worried about inflation being at 3.5%. There's a lot of academic evidence that shows once inflation starts to approach 4%, that firms and households pay a lot more attention to it and become more concerned by it. There's also a lot of evidence that there are certain parts of the sort of basket of goods, inflation in certain products that consumers are more focused on. One of the probably obvious ones is food, simply because food's a big part of the consumer basket. It's over 10%, and also people are shopping for food very regularly. Food price inflation at the moment is about 4.5%. So again, that's a worry for people on the committee, because they're worried in a sense that will feed through into higher household expectations for inflation. I would say that those who've been looking to wanted to cut rates at the last meeting, they're probably more seeing the balance of risks as being deflationary in terms of seeing employment growth falling, seeing activity being very weak. And in a sense, they're more worried, I think, about thinking that perhaps 4.25% now is too high an interest rate when you're looking at 12, 18 months with an economy that's weakening, and that they're seeing more of a risk of sort of undershooting the inflation target. So that's a little bit about sort of where rates might be going. The current expectation in financial markets is that there will be 2 further 0.25% cuts this year, so that by the end of 2025 we'll be at 3.75%. There's a very high expectation that there'll be a cut at the August meeting, which is I think the first week of August. So if you could move us on another slide, please, Darren. Look, this is the last one from me. So this is really sort of, I think, focusing in particularly on wage inflation. So this is probably one of the key, it's the key variable in the sense that the Monetary Policy Committee track, and that will determine how quickly and when interest rates come down. I did say earlier, we're seeing a significant loosening in the labour market. This chart is showing sort of a historical series which has got an agency network pay survey outcome. So that's the orange diamonds. We've done this pay survey of our business contacts for the last sort of I think about 15 or so years, more than that, and it's been a very good predictor of actually how wage settlements have moved. So you can see the orange bar, and then the purple bar for 2025. Purple diamond is the sort of predictor from the survey, and then the blue line is actual pay settlements from the pay settlements database. So when we did this survey around the turn of 2024-25, the firms that we surveyed were thinking that wage settlements would be 3.5 to 4% broadly by the end of the year. Now, the actual data that's coming out is suggesting that we're on target for that. I think if wage pressure continues to moderate, then those sort of expectations for further interest rate cuts for this year and probably going into 2026 will come to fruition. It's a key thing that the Monetary Policy Committee look at, and we are seeing, I think, wage inflation sort of dissipate broadly as we'd expected. Move us on one, Darren, but I think that's my last slide, so we can move on to some Q&A.
Bring video back there for a moment. Paul, thanks very much for that really insightful run through of where we're currently sort of seeing things from the bank's perspective. To everyone on the line, please do use the chat function if you'd like to post any questions to Paul, or if you're feeling brave enough that you want to come online, then please just do pop a note in. We can unmute your line and you can put a question directly to Paul. We have had a few in advance that have been sent through to us. So Paul, I suppose just one question that came through yesterday evening was, what is the rationale? Why specifically do either the Bank of England or the government select 2% as a level of what's deemed to be acceptable inflation?
Yeah, it's a good question. There's no particular scientific basis to it. I think broadly, I mentioned earlier that there's a lot of sort of academic evidence that if inflation gets to around about 4%, that it starts to become more of a problem, because people start to have an expectation that prices are going to be continually rising, so people will bid for higher wages and so on. So I think broadly you could say, why 2%? Well, partly thinking about whether it should be higher. I think the expectation is that if you had, say, a target of 3% or 3.5%, you're sort of getting closer to that 4% boundary, where actually you're at risk of inflation accelerating. So on the upside, I think broadly you could see that's why it's 2%. On the sort of lower side, the general argument is that we don't want sort of high runaway inflation, but nor do we want prices falling, because if prices are falling, firms and households tend to rein in their spending, because if you think things are going to be cheaper in the future, you'll stop spending, and the economy can grind to a halt, which can be a really big issue. So again, if you were going for, say, 1% as an inflation target, well, actually, you're getting close to zero. If you're undershooting the target, you can start to have deflation, so you're more at risk of a deflationary spiral. So there's a bit of a rationale to it, but there's no real sort of scientific reason that it's 2 rather than 1.5 or 2.5 or anything else. But hopefully that gives you some sort of idea of why 2%.
Effectively splitting the difference between 0 and 4, then, by the sounds of it, Paul.
Well, yes, I think you could put it like that. It's a little bit pulling it, finger in the air, isn't it? Yeah, but I think that's about right.
I suppose still on a similar theme around inflation and the impact on rates more specifically, Paul. We have seen some comments around from the Governor of the Bank of England recently, that specifically kind of looking out for some softening of the employment market to drive perhaps rates down from where they currently are. So again, are there any particular kind of insights as to why it's such a focus, the employment market, in terms of making that decision around future cuts on interest rates?
Yeah, I think when we're looking at inflation, you might think, if we have, say, imported products, there's not a lot that the interest rate can do directly about, say, the cost of imports from China of, let's say, white goods or furniture or whatever it is. It will depend on what's going on in the Chinese economy and broadly what the exchange rate is. We focus on the labour market because it tends to be, or the UK labour market, because it tends to be a very high proportion of costs in sort of service sector industries, which tend to be more domestic industries. So if you look at goods markets, there's a lot of imports coming in. But if you look at services, things like transport, hospitality, hotels, your haircuts, whatever it is, they tend to be more labour intensive. So in those sort of sectors, the labour market in the UK can really drive inflation. So that's the reason that there's always a big focus on on sort of UK wage inflation. The sort of levels of wage inflation we had, a year ago or so at sort of 5-6% plus weren't consistent with the 2% inflation target. So that tends to be the reason, because it's something consistent over time, whereas you're always going to get variations in, say, energy prices, oil prices, food prices, general import prices. They will tend to sort of, be very variable. But the labour market is something that we can look at consistently over time.
Okay, thank you, Paul. Yeah, makes sense. So a couple of questions have now come through from today's participants. So firstly, just regarding sort of wage inflation, a question as to why sort of public sector figures aren't shown in the charts that you had earlier on, Paul. I mean, are they factored in for a start, and any explanation as to why they're not sort of shown in the charts?
Yeah, I think that if you're referring to the chart, which is the chart I showed for sort of pay settlements, I think that's broadly because our survey reflects, we don't speak to public sector bodies, we speak to businesses. So we've taken a sort of settlements in the private sector as a sort of, actually is what our survey is telling us. Is it tracking actual outcomes? The general sense I know amongst, we have a big team looking at sort of the employment, the labour market, is that public sector wages tend to lag private sector wages. So we've seen some big increases in public sector wages more recently, in probably the last sort of 12 months, whereas actually we saw some really big increases in private sector wages in 2022-23. So there is generally, I think, an expectation, and not everyone agrees with this, and I hear some businesses say this, that the public sector wage increases, bigger increases now, aren't necessarily going to drive higher expectations for private sector wage increases, because the sort of the causality almost, is almost the other way around. It's the public sector tends to lag the private sector. So I think, given that private sector wages are coming down now, or the rate of growth is coming down, not actual wages, but the increases are coming down, you'd expect to see public sector pay moderate, I would think, over the next sort of year to 2 years. That's my general understanding of how they look at it.
Okay, thank you, Paul. Quite a specific question coming in here now, again from a participant, and I think I'll put a little bit of a caveat on this one on your behalf, Paul, in that perhaps this one ought to be maybe a personal view rather than one of the Bank of England or a professional view. But a question around interest rates and the forecast there. Have you got any sort of personal view on what you might think of as being something of a worst case for what might happen to interest rates over perhaps the sort of short to medium term?
Yeah, look, this is really difficult for me to answer, I would say. I mean, I think the best thing to look at is what's the central market expectation for rates, and I think the current market expectation is that rates, will fall this year and into next year, and will settle at around sort of 3%. Now, I guess if you were looking at if you were thinking that was your central case, that gradual decline in rates to about 3%, and it's 3% going forward, you might say, well, actually, a worst case might be it's double. It would, clearly, it's going to depend on, if interest rates were higher than 3, there's going to be some very strong sort of positive shock to the economy. Activity is going to be a lot higher than we'd expect. If rates were, significantly lower, you'd be thinking there'd be some sort of unforeseen negative shock, which meant that we had to reduce rates a lot lower. So I think that's the best sort of guess. It is a guess that I can really give on that.
Thanks, Paul. Appreciate that. Was a pretty tricky question for you and putting you on the spot there. I mean, still sticking with the theme of interest rates, and again, this is a sort of question that sort of came through in advance of this morning's session, is that in some of the previous kind of editions of this seminar that we've run, we have spoken about perhaps when inflation was spiking. There were some commentators in the market that were saying that the Bank of England was a bit slow to react there in terms of increasing interest rates. Whilst we are seeing a little bit of persistence with that rate of inflation at the moment, we are obviously kind of suffering as an economy from a lack of growth. Is there a risk here that perhaps the bank are being a little bit hesitant, a little bit too slow, perhaps to look at reducing interest rates to help drive some growth?
Look, there's always a risk. I think there's always a risk of getting it wrong. And I suppose if you think getting it wrong means you're not somehow picking an optimal path for interest rates, you're almost inevitably gonna get it wrong because in a sense you'll never know because you don't know what the sort of counterfactual is. But the idea that somehow you've always got the interest rate that's absolutely optimal for the economy going forward is, it's sort of impossible. But I think that's probably a bit theoretical. Is there a risk that rates are, that we're pushing down on growth or on activity too much now, and actually that's going to impact the economy, and we might see a recession or inflation heading to zero? Then absolutely there's a risk of that. I think that's a risk that's recognised by the committee, and that's why you see three people wanting to cut at the last meeting. And as I said, we think a neutral rate is 3%. So we are still restricting demand and activity in the economy. So look, there is always a risk of getting it wrong, and I think that reflects why that committee gets bombarded with a lot of data every sort of 6 weeks. So they've got a meeting pretty much every 6-7 weeks. Why they make a decision 8 times a year, and why we do sort of 4 forecasts a year, because things do change. Things can change quite quickly. So we're always sort of on the lookout for that. So we're doing our best not to make a mistake, but there is always a risk of making a mistake for sure.
Thanks, Paul. I've just got one more question that had been submitted through in advance. So I suppose before we go into that, just a final call for anyone that's on the line this morning. If you do want to put anything through to Paul, now's the opportunity to do so. So Paul, again, I think this is probably a topic that I recall having come up in the past, but the question around how much almost kind of control do we have over our own economy through the use of interest rates, and inflation, and the factors that feed into that, when I think, as you've mentioned previously already, so much of what we rely upon as a nation is imported. It's outside of our control, and clearly there's those external factors like we saw around Liberation Day and what's happening in North America, and these other kind of global events that have such a significant impact on our own economy. So how in control of things do the Bank of England sort of really feel?
Look, I suppose we're in control of what we're in control of. We could set the interest rate. It's a key lever of policy, and I suppose you would say that the government are in control of what they can control. They can determine taxation and spend and that sort of fiscal balance. So there is a degree of control from having the Bank of England setting rates and having a government setting fiscal policy. But the UK is a small and very open economy, so we are buffeted by whatever is happening globally. We're a trading nation. We have very open financial markets. We have a floating exchange rate. We don't try and control, financial flows. So that is the economic model that we've chosen. So we can control some things, but of course there's a whole lot of stuff out there that we can't control. And we've seen what the impact can be if European gas prices rise 20 times from where they were before because of an invasion of Ukraine. That actually, the economic impact of that is enormous, and there's very little we can do about that in the short term. Now, maybe there's more in the long term if you're thinking, well, we don't want to be reliant on cheap imported Russian gas, which clearly we don't want to be, or will never be again in the future. So there's changes you can make in the long term, I think, as well. But short term, yeah, we control certain things, but because it's an uncertain and volatile world out there as well.
Okay, thank you, Paul. Um, so again, a couple of questions that have just come through now. Then again, talking back about the picture around sort of employment and unemployment in particular. So a question around, I suppose, the specifics of exactly how that is sort of calculated from the bank's perspective. I suppose looking at the numerator and denominators in that sort of equation. Specifically, how are things like those that are economically inactive sort of factored in, people that are incapable of work, how does the bank arrive at the numbers that it uses to formulate that calculation?
Was that say it again? Was that the labour market? The
Around, yeah,
unemployment?
around the sort of unemployment statistics, Paul. How does the
Right.
bank
No,
actually
sure.
sort of
Um,
obtain the data to calculate that?
yeah. So let me say about that. So the unemployment numbers are based on um, they're collected by the Office of National Statistics. They're based on something called the Labour Force Survey, and there's been a lot of stuff in the press and I suppose in Parliament about this in the last couple of years. That survey has become somewhat unreliable, and the bank's been a bit. I think, well, a lot of economic organisations have been a bit concerned about whether the unemployment numbers are really showing the sort of true level of unemployment in the economy. But we get the number from the ONS. We look at things like inactivity. So you mentioned inactivity. So people who are economically inactive aren't they're not unemployed. They're economically inactive. So this is working age people who, for whatever reason, aren't in the workforce. We saw that increase a lot during COVID. There was certain groups in the economy where it increased a lot. I think older males citing ill health as a reason for not working was, for example, a major category. Now that's come back a bit after COVID, but I don't think economic activity and participation in the workforce is back to where it was pre-COVID yet. So we do a lot of work around analysing the labour market because the extent to which there's slack in the labour market is a key issue for us. So we'd look at sort of firm levels of vacancies. We look at surveys about whether firms are finding it difficult to recruit and retain staff and so on. So look, there's lots of different indicators we can use, and we look across them all and try and build up a sort of consistent view of is the labour market tight or is it loosening?
Okay. Thank you, Paul. And I suppose a bit of a follow-on question to that is around how the Bank of England might sort of question or look at the causes of unemployment. Is it relevant to the bank's perspective to think about is it policy changes that are causing perhaps an increase in unemployment, or whether it's perhaps adaptation of new technologies? Obviously, everyone's talking a lot about artificial intelligence right now, and impacts that might have on specific kind of groups
I've
of
lost you a second
employment.
there, Pete. I
Oh,
don't know. I missed a
sorry,
bit of that,
Olivia.
Pete.
No
I don't know if
problem.
that was for everyone or just my end, but I missed a little bit at the end.
No problem. Let me just repeat there then, Paul. So yes, just following on this point around sort of unemployment and the specifics of how the bank look at it. Is it relevant from the Bank of England's perspective as to whether it's changes in policy that are impacting on unemployment? Is it relevant, whether it's changes in technology? And as I say, lots of talk right now about artificial intelligence and the adoption of that could have impacts on the number of roles available. Are these factors that the Bank of England are concerned about in any way?
Yeah, we are concerned about them. I suppose in a sense, we're using the sort of labour market as an indicator of almost how much spare capacity there is in the economy. So if you've got a very tight labour market, low unemployment, low economic, high economic activity, employment growth, then actually you've got wage pressure, you've probably got inflationary pressure. Whereas actually, if unemployment's rising, wage pressure isn't as high. You could say, well, actually, we've got a bit of slack in the economy, so the supply side can react maybe to slightly higher demand. So that's how we're using the sort of labour market as an indicator of the inflationary pressure in the economy. So we are interested in things like I think AI, in the sense that if there was a very rapid change, that could change quite quickly what the labour market was telling you about sort of slack or tightness in the overall economy. The general sense I think we have at the moment, and this is partly based on some surveys we've done with firms, is that AI adoption is sort of happening, but it's probably a reasonably slow progress, a bit like I think probably digital technology over the last, I suppose it's 30 plus years now, isn't it? That actually, it takes time for these sort of general changes in technology to feed through actually into processes and labour market outcomes. But if something happened actually that made it a lot quicker, yeah, we'd want to look at that very intensely. We are interested in sort of structural change in the economy, although our focus is more on the sort of short term, the 2 to 3 year sort of horizon.
Thanks, Paul. Just one final question, then perhaps we look.
Okay. You're breaking up a bit, Pete, for me at least. I don't know. Pete, I can't hear you at the moment. I don't know if it's my end or if it's a problem for everybody.
Maybe back there after a brief
All right.
interruption.
Right, I can hear you again, Pete. I missed that last question. Sorry.
Sure. What would you say if someone suggested that perhaps the increase in interest rates that we've seen over recent years have actually been the driver for demand of higher wages?
It's interesting. This has come up a number of times. I've discussed this with some of our policy committee members actually, because businesses have talked about this. Basically saying, look, if people have got higher mortgage payments, lo and behold, they're going to bid for higher wages in a tight labour market. There's a sense that they can get them. So I think what I would say is, and I think what they would say is that the sort of evidence is that in a tight labour market, interest rates are still effective in pulling back on inflation, but actually that there is this sort of channel that is also pushing up a bit. So you've got to almost raise interest rates more to get the same effect when you've got a really tight labour market and actually people are able to push through wage increases. So yeah, I think it's a point well made, and probably in sort of 2022, 23, when we know unemployment was really low, when there were lots of labour shortages, that actually interest rates overall were pulling down on inflation, but not as much as they would have been if the labour market was looser.
Yeah. Well, quite the unenviable job that the Bank of England has there, then, in terms of finding the solutions. But Paul, look, I think with that, we'd like to sort of wrap up this morning's session. So, on behalf of everyone that's attended this morning, thank you very much for giving up some of your time today to come and share some insights. To everyone that's joined us this morning, again, thank you for giving up your time. Hopefully, you found it a useful session. We really enjoy hosting this one with you, Paul. I'm sure we'll be doing it again in the future. With that, I'll thank everyone for coming on board and wish you all a pleasant day. So thank you very much.
Thanks, Pete. Thanks, everybody.